Well, good afternoon. Welcome to my course, Group Accounting. And I would like to repeat what we did on Friday last week, just by looking at the slides. I think there was only one issue that we looked at, besides looking back to what we did on Thursday. So on Friday, we looked at the 12-month window, and I think you understand there might be some problems if you acquire, if one company acquires another company, they have to include the acquired company into their group accounts, and therefore it takes some time to figure out what amounts, what fair values are there, what patterns that are not capitalized on the balance sheet. There are a lot of things that the controllers and financial, the CFOs, the chief financial officers have to do during such an acquisition. And therefore the Standard-Setter, well, understands that there might be some time issues. So they say, okay, if you just acquire a company, you have 12 months to find out what the fair values are and what are the items that should be sitting on the group accounts, whereas on the single financial statements, they will not be shown. And well, the first thing is what you should do is put some provisional amounts into the balance sheet. And then when you know more, when you know better, then just go back and retrospectively adjust those provisional amounts. And well, of course, if you find additional assets, additional liabilities that should be included in that calculation of goodwill, then please do that. Please add those items and change goodwill accordingly. So in that 12-month window, we will correct all the assets and liabilities that should go into the group accounts, and the counter account is goodwill. So we will change goodwill during that 12-month window. So what happens if the measurement period, that means the 12 months window, is closed? Well, everything goes into the profit and loss account. The goodwill will not be changed. And that's basically what the IFRS paragraph 45 will tell us. So we did a little case study on that one. I will not go back into that. I think that will then okay, so we will now go into other issues that are there when following an acquisition. So we have seen that we have added, that we have changed the book values of the investee to the fair values, and therefore the fair values have to be put into the single financial statements number 2. And well, the problem is that we will not change the book values of the acquired companies. So they will go on with their normal book values in their single financial statements number 1. So we have to account for these fair value adjustments in the time after the acquisition. And that will sometimes will done at subsidiary levels, so they will have shadow accounts in their bookkeeping system, or these adjustments will be done at group level. That means they will have some adjustments that they will just add on the bookkeeping what is done at the single financial statements level. So here is what will happen in practice after you have an acquisition made. You have made a fair value adjustment at the acquisition, and then you have to account for the differences because of the higher fair values. So fair value adjustments at acquisitions are made. You remember we changed the single financial statements number 1 to the single financial statements number 2, which means that we will add hidden reserves to the assets and then show the assets at fair value for the purpose of group accounting. For the purpose of the local accounts, we will not change these. So we are just talking about the fair value adjustments for group purposes. Now, those fair value adjustments at acquisitions are mostly recorded at the level of the parent when preparing the group accounts. The subsidiary keeps its own accounting system and continues the book values for the purpose of preparing separate financial statements of the subsidiary. So even if a company is within a group and they deliver the single financial statements number 2 or 3 to the group and to the group auditor, well, they have to prepare their own single financial statements for purposes of the statutory requirements. So that is the problem. And those fair value adjustments come mainly in the form of upward adjustments to intangibles and tangible assets, as well as the resulting deferred taxes. Now, what do we do in practice? Well, most of the time, what I've seen is that the controllers have Excel spreadsheets to account for the upward or downward adjustments, or they have a shadow accounting, they have shadow accounts in a double entry system, which will be eliminated for single financial statements number 1. So these shadow accounts will not show up in the single financial statements, but they will be used when it comes to the preparation of the single financial statements number 2, when it comes to group accounting. So that's how these things are captured in the practice. All right, so let's look at some of these adjustments just to get an understanding of what we have to do in consolidation. Let's assume that the fair value adjustments in subsequent periods have to be calculated for depreciable assets or for non-depreciable assets. So let's look at depreciable assets first. The difference between the fair value at the acquisition and the book value in the statutory accounts, in the local accounts, at the same date has to be depreciated over the remaining useful life of an asset. This can be done individually with a fixed assets register or for groups of assets based on estimations. So what we will do in practice, if we have, for instance, a building and the building has a book value of 100, and for purposes of the group, we said, well, the fair value of that building at acquisition is 150. Well, then we have 50. We have a fair value adjustment of 50, and we have to add that to the single financial statement number 2, right? So we have an additional book value, so to speak, for the group of 50, which has to be depreciated in the future. So what happens to the 100, the book value? Well, that one is already depreciated in its single financial statements. So we don't need to take care of the depreciation of the original book value because that will be accounted for in the local accounts. Okay. So when you look at the local accounts, you will have the depreciation for that book value of 100. But when you look at the group accounts, we have a fair value adjustment of 50, and that has to be depreciated over the same useful life as the underlying asset with the book value. So let's have an example. We have a purchase price that was allocated to one tangible asset and that has a remaining life of 5 years. So the book value at acquisition was 100. And we said that the fair value now is 120 at acquisition date. So the acquisition was on the 1st January of the year 1. Now, when we look at the following years, so this is year 1 with the acquisition, we have years 2, 3, 4, and 5, and we have a book value of 100. And what is the depreciation? What is the subsidiary doing? Well, they will depreciate this same item, which has a book value of 100, over their remaining future life. So they will, let's assume that's 5 years, and they will depreciate that over the last 5 years like so. So 20, 20, 20. So the book value at the end of year 1 would be 80. That will be forwarded to the next period. Again, a depreciation of 20. So we have a book value at the end of year 2 of 60. And we go on like this. So at the end of year 5, we have a book value of 0. But those are the local accounts, right? When we look at the subsidiary, they have this in their single financial statements number 1, they depreciate the book value. But when we look at the group, well, the group has acquired that item with the acquisition and put a fair value of 120 to that building, because there was an expert who said, well, the building has a fair value of 120. So what is the difference? The difference are the hidden reserves between 100 and 120, and that was up valued to this building. So in total, when you look at the group accounts, they will have a fair value, which is then, of course, a book value in the group accounts of 120. So what do we have to do? Well, we have to write down, we have to depreciate this fair value adjustment of 20. So from 100 to 120 is this fair value adjustment. We have to depreciate that fair value adjustment over the following 5 years using the same depreciation method. So that would mean that we have to divide 20 by 5, and we get an annual depreciation of 4. So 4 will be the depreciation for the years 1 to 5. So you can see this row of depreciation. And when you do the math, then in the first year, when you have a fair value adjustment of 20 that relates to that building, then we have an additional depreciation of 4. So the book value of that fair value adjustment is 16 after the first year, 12 after the second year, 8 after the third year, and so on. And after 5 years, the fair value adjustment has been completely depreciated to zero. All right. Now, what will we see in the single financial statements? Well, we will see in these years, we will see a depreciation of 20. But for the group accounts, we need to have a depreciation which is based on the fair value of 120. So we just add the depreciation on the fair value adjustment to that depreciation of the normal depreciation of the subsidiary. And in total, we have, when we take the depreciation of the subsidiary of 20 and add the depreciation of the fair value adjustment, we come up with the total depreciation on the fair value of the asset at acquisition. So that is the same as dividing 120 by 5, which will give you 5 times 24. All right, so that is the principle how we would allocate the fair value adjustment to the group accounts, and then follow up for the consequences that the fair value adjustment will cause in the future. So if you have an asset and that asset is already depreciated based on the book value in the local accounts, so you just have to add the difference between the fair value of that item and the book value of the acquired asset. And then you will add the depreciation of the fair value adjustment to the depreciation that is already booked in the accounts of the subsidiary. And in total, you get the correct depreciation, which is, well, coming from 2 sources. One is the book values from the subsidiary. They will just deliver the normal depreciation based on the book value at acquisition. And then you have to add the depreciation of the increase in value, which is called the fair value adjustment. Okay. So what do you think? Did you get that, or do you have questions regarding my cup? No, sorry, regarding the example. Well, I can turn that round. I think that's also very nice. Can you see that? Maybe a little bit nearer this one. Okay. So in the meantime, you had some time to think about my question. So what do you think? Did you get that, or still questions? No questions? Okay, I'm glad. Well, we will see whether you have questions in the exam, right? Okay. So that's basically a principle that you will find throughout consolidation. So you have to, well, think about what is already included in the group accounts when you make the consolidation. Well, from the subsidiaries, you will get the single financial statements, number 2, which include the depreciation for the original book value. And you just have to add the difference, which is called the fair value adjustment. And well, you have to depreciate in addition to what the subsidiary is already doing on the book value. So 2 information streams will then result in the correct total depreciation for that acquired asset at fair value. All right, so let's go to the next one. This is an interesting one. Let me just look at chat. I think the fair value of 31st December of the period one is 120. Yes, of course, 120 minus 24. So you could say 120 minus 24 equals 96. Must be the book value of the original item at book value plus the fair value of the fair value adjustment at the end of the year. So at the end of the year, the book value, I wouldn't call it a fair value as of 31st December, because the fair value might be a different one. We only look at fair values at acquisition date, and then we will use that as a book value and then write that, roll that forward, and that is based on book values. So I just distinguish between book value and fair value regarding the fair value adjustments. But you're right. You told me in chat that the book value of that item in the group accounts will be 80 plus 16. Yes. Okay. All right. So we come to another very interesting thing. This is rather complicated, so I would like you to listen very carefully, because it's not easy, and that is because it could also be in a exam. So please make sure that you understand that example and that you are able to calculate that table in the exam, so you will be best prepared for practice, because a lot of these things will then happen in practice, and you have to account for those things. So here is a fair value adjustment on a liability. So in the first example, we looked at an asset like a building. And here in this example, we will look at a fair value adjustment on a liability and how that is accounted for. So here are the facts. There is a contingent liability not recorded by the investee, and that will be valued at fair value and recognized in the group accounts. So normally when you have a contingent liability, you will not put that contingent liability into the books of the investee. But when you acquire such a investee that has a contingent liability, we call that an acquired contingent liability, and therefore you have to consider that in the purchase price allocation, and therefore it is a group asset, and you have to put a value to that. So that is one thing that often comes up in mergers and acquisition. You have to follow up on contingent liabilities. The other thing could be a pension provision that will be grossed up to reflect a finance cost. So at acquisition, you will buy a pension provision. In order not to pay too much, you will assume that pension provision that is booked by the investee, and that pension provision will be grossed up each year, so to reflect the finance cost, and that also has to be done in the group accounts. Because the pension provision in the group accounts might be different to that what is recorded in the investee's account, so there might be a difference. And then loans or leasing liabilities accounting for using the effective interest methods, and that also those also have to be grossed up. And to show that, I would like you to do a little case study, and here are the facts and circumstances. So in the year 0, that is 2 years before the acquisition, London borrowed a loan from $190,000 from another bank at 5% interest. So obviously, 2 years ago, the market interest was 5%. Okay, so and at that market rate, London, which is a company, borrowed a loan from a bank. So 2 years later, so after that borrowing of the loan, England, that's another corporation, acquired London, and we have a group, right? As the market interest had decreased from 5 to 4% at the acquisition date, England assumed a liability of $217,000 for the payment of the $254,618 at the year end of year 6. Well, we will come to those numbers in a minute, so you can see them. I think in the table. I think that's better to understand. So here is the table that the chief accountant or his assistant did 2 years ago. So when they acquired, so let's go back. Sorry, go back to the facts here. So in the year 0, London took a loan of 119 at 5%. So they had in year 0 a liability of 190, and when they gross up the finance charge and what they have to pay back, because the loan will not be, or the interest for the loan will not be paid during the 6 years, which is different to maybe what we know in practice, because normally you have to pay in installments monthly or once a year or twice a year. But in this case, the loan contract says that they have to pay the amount in one sum at the end of the 6 years. So, okay, what will happen? Well, first they will gross up. So they have a finance charge of 5%. So 5% based on 190, and you may just check it. 190 times 5% is 9,500. So at the end of year 1, we have a total liability of 199,500. So 199,500 times 5% equals 9,975. That will be the interest for the second year. And then, well, that will be added to the liability. So we have a liability at the year end of year 2 of 209,000. So then, of course, the table goes on, and I don't go through each and every line. I think you get the point. At the year end 6, there is a liability of 0 because they paid the total amount of 190,000 plus 64,000 finance charge or interest. They paid the 254,000 in one sum. So that is the accounting in the single financial statements of London. Okay, so that is the book value, that is the statutory accounts, or the the numbers for the statutory accounts, for the local accounts, as you could say, of London. Now, England buys London, and now they have to look at the payment of 254,000, which is based on an interest, on a market interest of 5%. So when London took the loan, the market interest was 5%. But now, 2 years later, the market has changed, and the market interest is now 4 instead of 5%. So when looking at the 254,000 in year 6, so what does that mean if they have to pay that amount of money in 4 years' time? So they will just they will discount the 254,618 divided by 1.0, and that 4 times. 1, 2, 3, 4. And the fair value of that liability is 217,649. Okay. So now please finish that table because we have to do now the calculation for the years 3 to 6 for the group accounts, and we have to find out the fair value adjustment to the liability and the fair value adjustment to the finance charge. Okay, so I will stop the recording now. So welcome back from the breakout rooms. So we have looked at the fair value adjustments of a liability, you know, the facts and circumstances on slide 164. And here we now have my suggested solution. Well, the problem was that London, which is a company that had borrowed a loan from another bank at 5% market interest, and they have prepared the table 1 to account for the grossing up, because the loan will be paid back in one lump sum at the end of year 6. So we have to calculate the interest at the year ends 1 to 6, and then have to come up with the liability, which is included in the single financial statement number 1, which is the local account of London. So they will have these finance charges in the years 1 to 6, and well, we'll show a liability up to 254,000, and in year 6 they will have to pay the principal, that means the original loan, plus all the finance charges they have accrued for in the liability. So that is 254,000 at the end of year 6. Now, this company is acquired by England. So England buys London at the end of year 2. So that is normal. When a merger takes place, they don't wait till they have finished all their tables and finished all their paid back all their liabilities. They just enter into the middle of it, right? And so we have to account for these things for group accounts, and that is the second table that the controller of the group is preparing based on the acquisition of the company London. Now, when the controller sets up this table, he or she will take account for the difference in the market interest. So facts and circumstances say that the market interest had decreased from 5 to 4%. So a payment in 2000 after the year 6 will have to be discounted at 4% rather than 5%, because at the acquisition date, the market interest was 4%. And based on the 4% market interest, we have to find out the fair value of assets and liabilities. So in this case, it's a liability. And we know that London has to pay 254,000 after year 6. So that number will be put into the table as the final payment, because that is the same. That is the nominal amount that will have to be paid at the year end, because the loan contract will follow these numbers. And these numbers are already in the books of London, and London will take that table to prepare the single financial statements number 1, so the local accounts based on these numbers. But for group accounts, we have to consider this market interest decrease, and we will discount the 254,618 by 4%. So if we do that, if we discount that 1, 2, 3, 4 times, so that is 254,618 divided by 104 to the power of 4, then we will get 217,649, which is the starting point for the group accounts, because at that acquisition date, they acquired London. All right, so that is the starting point, and the group controller will prepare the statements, the group financial statements, and the group financial statements should look like this. So in the first year, which is the end of the year 2 of that loan, the liability will be 217,649. So if we calculate 217,649 times 4%, that is 8,706. So that it will be the finance charge that has to go through the income statement of the group. But the problem now is that we already have a finance charge in the single financial statements. So that's the same thing as the building. We have original depreciation in the book, and we have to add the fair value adjustment to it to come up with the total correct depreciation from the group's perspective. We have to do the same here for the liability. We already have a liability in the group account. So in the we have already a liability in a single financial statement of 209. So we have to add something. We have to credit the group liability by 8,174. So that fair value adjustment will be booked by the controller of the group. So he or she will just debit, well, what will you debit? I think retained earnings, because that is related, a difference related to the past 2 years. So he or she will debit retained earnings and then credit the liability. So the total liability will be 217. Now for the year 3, we will already have a finance charge in the single financial statement of 10,474. These will go into the group accounts by our adding up all the interest charges from the parent and from the subsidiaries. But when you look at the table, that interest charge for the year 3 based on 4% should only be 8,706. So we have to adjust the number which is in the P&L to the 10,474. We have to adjust that to come up with 8,706. And that is the fair value adjustment that you have calculated here in the last column of 1,768. So that that fair value adjustment will reflect the market interest change from 5 to 4% and will then be used to calculate the correct finance charge. So we will see in the last columns the correction amounts that will be used to cut out the difference in the first place, the 8,174, which we had used to adjust the loan in the first year when England acquired London. All right. So this table is based on 5%, and that is the original contract. And this table is based on 4%. So we see that there will be a difference in the balance sheet. So here we have the differences for the balance sheet, and here we have the differences for the income statement. In the long run, we're all dead. You know that already. So when we have paid everything, also the difference, the fair value difference in the liability will be changed, will be eliminated. All right. So questions? No, is that clear? Okay, so we'll see whether you can do that in the exam, and well, I hope for the best. Okay. Now, what were my key messages when it comes to fair value adjustments? Well, the key messages are when we have intangible assets, they will be identified at acquisition and they will be valued at fair value. So the problem with intangible assets is that sometimes the company which was acquired was not in a position to be able to value the cost for that item. So most of the time, intangible assets are valued at a very low book value, which does not represent the fair value. So the difference might be huge. Think of a patent that was developed by the company, and the 6 criteria were not met before they were acquired. So that would mean that the patent has to be valued at fair value, where the book value is 0. So we have that problem. Thus decreasing goodwill arising from the acquisition or increasing a possible lucky buy or bad will. So intangible assets, if you identify, will decrease goodwill, or if there is no goodwill, will increase the possible lucky buy, if any, or a bad will. Well, then we have to look at the 12-month window. fair values can be corrected, or they must be corrected within the 12-month window. So everything you find in that changes assets, or the value of assets, or additional assets or liabilities are found that were not considered during the purchase price acquisition, they must be corrected on a retrospective basis. After the 12 months after the acquisition, and that can be during the year, the 12-month window will be closed, and corrections, if you find changes after that date, they will go directly into the income statement, increase the profit or decrease or increase the loss. So they will be shown in the P&L. The goodwill will not be changed by such a correction. Of course, you have to look at the goodwill on an annual basis, so to test whether the goodwill is impaired. But that has nothing to do with a 12-month window. You have to do that anyway. All right, then we looked at the fair value adjustments on assets. So these are subsequent adjustments that have to be considered in the following years. So for instance, we looked at additional depreciation. We had a building that was had a book value, and of course, when it was acquired, the building has a different fair value. So the fair value, the fair value adjustment on that building will be depreciated over the useful life, the remaining useful life of the asset, and therefore it will cause an additional depreciation for the group accounts. And same thing when you have a disposal. So when you dispose that building off, and in the single financial statements, you have a different book value than compared to the consolidated financial statement, the gain or loss on the disposal may be different in the single financial statements compared to the consolidated financial statements. So this is also just as consequence of having two different amounts, book values and fair values, in the single financial statements and the consolidated financial statements. And same thing with fair value adjustments on liabilities. Contingent liabilities may increase or decrease. So for instance, you have a lawsuit that was considered at acquisition to be 30% probable. So you don't have to set that up in the single financial statements. But of course, when it is acquired by a parent, the parent has to put that 30% probable lawsuit into consideration, and therefore put a number based on the probability of 30% to the group accounts. And then later it turns out that the lawsuit was unfavorable for the company. So the company lost the lawsuit. So you have to put in 100% of the contingent liability, which now turns out to be a real liability, because the lawsuit was on which it was contingent was lost. Okay, so that is clear. And then on the other hand, we looked at the loan, at a loan that can be changed according to the interest levels. The market interest can change from 4 to 5, so increase, or it can decrease from 6 to 3 or whatsoever. So you have to account for the difference in fair value based on the nominal amounts that you have to pay, and you have to discount those to the date of acquisition and then prepare a table based on which you have to calculate the fair value adjustments for the balance sheet and the fair value adjustments for the income statement. All right, so any questions to the key messages? Okay, so then we can go to the full consolidation, which is the consolidation method for accounting for the subsidiaries. So that is what we will look at with the next two slides. So we have a consolidation procedure for subsidiaries, and the full consolidation is described as following these three steps. Yes, the three steps. So you have to combine in the first step like items, so items that are the same. So same, no difference. You just put in one category. So you will combine same assets. So machines, you will combine with machines from the parent, and the subsidiaries, you will put them in a row and then aggregate those assets to form the group accounts. Same thing you do with liabilities, with equity, with income and expenses. So not only for the balance sheet, you will also do that for the income statement. And of course, you will combine like items in the cash flow statement of the parent with those of its subsidiaries. So that is the first step, combine like items. We will aggregate them and put them into a subtotal. Then in the second step, we will offset things that are no group accounts. So we will offset or eliminate the carrying amounts of the parent's investment in each subsidiary and the parent's portion of the equity of each subsidiary. So we already did that. So you have an understanding, a basic understanding of this offsetting, which is called the equity consolidation. So we will consolidate the equity of the subsidiary with the investment, which is shown in the parent's books. And then in the third step, we will eliminate in full any intragroup assets and liabilities. So for instance, if you have a loan from the parent to a subsidiary, well, the loan will be shown on the asset side because it is due from a subsidiary. And in the books of the subsidiary, you will of course show a liability to the parent. But this, from the group's perspective, is a loan from the left pocket to the right pocket. And you will not show that in a single financial statement. And therefore, in the group accounts, you have to eliminate those intragroup assets and liabilities. Same thing for equity, income, expenses, and also cash flows relating to transactions between entities of the group. So not only between a parent and a subsidiary, also between a subsidiary A and subsidiary B. Now let's look at the first step, which is called the equity consolidation or capital consolidation. You will find both terms in the practice. And well, we will look at Mount again, but here for the purpose of equity consolidation. So you have the same facts as we have seen before. We have Mount that acquired 60% of the share capital of Everest. The total shares are 200 million. At acquisition date, the purchase price was 900 million. Net assets of Everest were 800 million, and Everest shares were quoted on a stock exchange at 5 each. At year end, we have retained earnings of Mount. They are 500 million. Net assets are 950, and goodwill was impaired by 100 million. And now we will look how you would account for this same example if the non-controlling interests were valued using the fair value method. So that would be A, or B, if NCA was valued on the proportionate basis. So we will look at that example, and you are required to make these two adjustments and then perform the capital consolidation. Let me see. Well, I think it will rather take more than 12 minutes. So I would really like to make the break now. And then after the break, with all fresh brain cells, we can go to this case study. Okay, so I will resume, I will stop the recording.